and I'm going to talk about unconventional economics. In this first case, I'm going to talk about the benefits of permanent life insurance or talk about life insurance. There are mainly two types of life insurance. There is term life and there is permanent life. Now, term life is very simple. In term life, you buy protection, but that's the only thing that you get. And protection for your loved ones. And you bet against you dying. So you are betting to lose because you don't want to die within the term period. And the insurance company is betting that you don't die because they don't want to pay the death benefit. So if they win, they make a ton of money. If you win, that means that your loved ones would get the death benefit and the insurance company will lose. But if you don't die, which is what I believe you would like, then you lose because you lose a lot of money. So that's term life. And term life, it still has uses because you can be very young with people that depend on you. So you want to protect your income. So in case you disappear, in case you die, they will adjust to life without you a little easier. And what is permanent life insurance? Well, permanent life insurance is here. Permanent life insurance is a type of insurance that is for your whole life, that is for all your life. That's why the first type of permanent life insurance that we learn of or that was created was whole life insurance, which it was designed to cover you for all your life. That's why it was called whole life. But in the in the 70s, things started to change and appear something called universal life, which is supposed to unbundle and make life insurance very transparent so you could understand where the money goes when you pay for insurance. That part of it will go to pay for insurance for the death benefit, and the other part would be for growing some savings because that's what permanent life insurance does. And so I hope if somebody is watching this video, if you want to put some comments, I will be able to read them and I would actually could put them in the video. So universal life, it was that design that appeared in the 70s. And again, the idea was that it will be very clear to understand it because whole life is a bundle of death benefit and savings and cash value, but it is not easy to separate it. It's, in that sense, it's a little complex, but that doesn't mean there is anything wrong with it. But anyway, somebody wanted to make it more transparent, and they came up with universal life. But the truth is, it's not a very good solution, and I'll say why. Then to improve that came variable life. There is also a flavor of variable universal life, which allows to be able to change the benefit and the premium. And it's variable because it is played in the stock market. So that's something that a lot of people like, that you had the opportunity to put your premium to work in the in Wall Street, in the stock market. But then again, that has some issues because the stock market is very volatile, and you could win big, but you could also lose big. So that's that's the main concern. Now, to improve that came something else called index universal life, which allows the money that is sent to the savings to be played in Wall Street, but not in stocks, but in an index. And that's supposed to make it less volatile. But still, you will have ups and downs. So, in order to cover the downs, the insurance companies for the index universal life, they decided to play some puts. Puts is when you win when the stock market goes down or when the index goes down. And that's how they solve that. But just to tell you that there is a big difference between whole life and the rest of permanent life varieties. And it is that in whole life, the insurance company bears all the risk. As long as you pay your premiums, the insurance company has to fulfill the promise that they have to provide that death benefit for your loved ones when you die. Excuse me. So the thing is, um, that's a big difference because uh, in whole life, we know with certainty, with absolute certainty, that if we pay the premiums, there is going to be a death benefit for our family and is going to be a predicted death benefit. In the case of the others, the death benefit is not going to be that certain because the income generating part of those permanent life varieties, it is an engine that could be um, some kind of an uh, income generating engine that works on the markets or maybe on a different type of platform that can provide uh, some income. The variable life and variable universal life, they definitely depend on the performance of Wall Street, of the particular market that you're playing the stocks with. And in the case of the index, it depends on the particular index, but then you still have the protection of the puts in case the index goes down. But there is something that those proponents of those varieties of permanent life insurance don't tell you. And it is that they are basically annual term life, annual renewal term life. What does that mean? That if you are 35-year-old, then that um, the cost of insurance for a 35-year-old that is healthy is inexpensive. Is very affordable. But what happens if you get to live to 85 years? Do you want to, if you are in good health, you don't want to live anymore? You don't want to live to 90 or 95? Yes, you do. But what happened at 85 years old or at 89? The cost of insurance is extremely high. So that affects the performance of those varieties of permanent life. So you might end up having to send additional payments in your premium or bigger premiums, something that doesn't happen with whole life. In whole life, your premium is the same at 35 or at 90 or 100. If the insurance that it was designed for you is designed to be paid up at 95 or 100 years old. But there are some that can be paid up at 65 or 70 or 75, or some of them is those ages or 30 years, whichever is longer. Some of them are even paid at 10 years. So there are a lot of advantages on whole life, and if you are able to put a lot of money into a 10 pay, then it's great because you don't have to pay any, you don't have to commit any more money to your insurance policy, but your insurance would still be growing because of the guaranteed interest and the dividends. So that's what I wanted to share with you, some things on life insurance. And something, I mean, all this information that I'm presenting to you is actually coming up of books like this, The Case for IBC. Oh, I need to do something here on my settings. I didn't realize that. I need to show in my virtual background that I have a green screen. So this is supposed to improve it. Okay. So I show you The Case for IBC, written by Nelson Nash and Carlos Lara and Robert P. Murphy, PhD in economics, and David Stern. David is the son-in-law of Nelson. There's this other very nice book that I'm reading now, What Would the Rockefellers Do? And this was written by Garrett B. Gunderson, who was a student of Nelson. But I like that little book a lot because he kind of has his own nuggets that I like. I like them a lot. And this is definitely the Bible for the infinite banking concept, um, becoming your own banker, that Garrett Gunderson calls it cash flow insurance. Um, my own website, I call it cash value bankers because we can bank on our savings, on our cash value. And other people call the same infinite banking concept um, in many ways, but it's basically becoming your own banker, sorry, with a didn't paying whole life insurance contract. So it is a fantastic platform and it's got so many benefits. It puts you in control, it's safe, you have access to money, no questions asked, has no volatility, it's got guaranteed interest, it pays you dividends that it have been in the company that we use. Those dividends have been paying for more than 100 years, so it's almost like guaranteed, but they are not. Um, it is also private, meaning it doesn't show to the IRS or to finance uh, guys when you are asking for financing help for your children for for high school. I mean for university. Um, so that's they don't see the amount of money that you have in there. So that's fantastic. That is uh, private. It is also protected in most states because it's classified the same as your retirement income, which is normally not touched when you have an accident and hurt somebody and that person sues you. So it's got all those benefits. It also grows tax deferred, and you can use the money tax free, and it passes your legacy to your loved ones tax free. You can also transfer it, so it's transferable. You can buy a policy on a child or a spouse, and then later on, you can transfer the ownership to them. So the benefits are incredible. So if you want to learn more about the benefits, contact me at jorgeeherrera.com. One thing that I learned on this little book that I like is about um, net worth. That we normally think that we have to build our net worth, and it's very difficult. And we work most of our life to build that net worth. But Garrett teaches us that we don't have to build our net worth. We can buy our net worth with dividend paying whole life insurance. We can buy our net worth by purchasing one of these contracts. It guarantees that we will have a net worth at the end of our lives that can pass to our beneficiaries as a legacy, and we have that certainty, and we don't have to fight all our lives to build the net worth. We can buy it. That's fantastic. Something else that is in the case for IBC is an analysis from Carlos Lara on how a dividend paying whole life insurance contract can be your alternate bank, because Carlos puts a video, a fantastic video, where he shows how a small business works, or how a small business works. And he shows how they have to come up with capital, and then they have to make sales. They definitely need sales. It's the blood of the business. If they don't get sales, they are done, because the sales are necessary to cover fixed expenses. What are those fixed expenses? Those fixed expenses are your employees, your I don't know. In Spanish it's nómina. I guess I think in English it might be called also nómina. I'm not sure, but anyway, to pay your employees, which is a fixed expense, you need sales. What is the second big expense? It is your rent, where you're going to have your business. And there are also other fixed expenses, your utilities, your marketing. And then these businesses work by selling sometimes with credit. To improve their sales, they sell on credit to their customers. Now, on the other side, the business owners can get credit from their providers, because their providers, they also want to improve their sales, so they many times give the merchandise to the small business owner in credit, but that is unprotected credit. So if the sales do not come as expected, then the business suffers in its cash flow. If the creditors of the business do not pay their bills, the small business owner has problem with his credit. I mean, with his cash flow. And yes, his credit, because then he cannot pay his bills, and then his credit can get ruined. So to solve that, the business owner goes to a commercial bank and they get a line of credit to be able to um, manage their cash flow. When sales are not good, they can use the line of credit to keep their cash flow to be able to pay the bills. And but um, when the sales are bad, the um, the business owner, the small business owner, might not be able to pay back the line of credit because that's what he normally do. He strives to make enough sales to pay his bills and pay the line of credit. But if the sales are not good, then the then the small business owner might not be able to pay the line of credit. What happened then? The bank is going to call the small business owner and invite him to the bank to give him the security that the small business owner is going to pay the line of credit by signing a note to benefit the bank. And in that note, Carlos mentioned that the bank pierces the corporate um, the corporate shield because in that note, the small business owner has to guarantee payment with his own um, net worth, with his own um, money, with his own properties. So, being that this is what happens with commercial banks, that is very dangerous, then Carlos talks about the alternate bank that a small business owner can start, which is an infinite banking, a private banking, taking a deal and paying whole life insurance contract with a mutual company. That will provide this small business owner with a way to manage his cash flow that has so many benefits compared to dealing with a commercial bank. It pays this deal and paying whole life insurance contract pays the small business owner guaranteed interest and dividends. It actually puts him in control on how to pay the loans. The small business owners decide how is he going to pay the loans. He doesn't have to go by the rules of the commercial bank that if he doesn't make a payment in the specified day, he gets penalized and his credit gets ruined. That doesn't happen with the alternate bank. And allows also the small business owner to manage his money with tax advantages. So, if you want to learn more about life insurance nuggets, contact me at jorgeeherrera.com. I will help you set up your private banking system. And I'll teach you about it, and I'll help you also with ideas on how to implement certain strategies, because it's called infinite banking because all the things that you can do with it. So thank you. I hope this video came out properly. So see you next time.